Hello friends, I hope all of you are doing well and good. I welcome you on my YouTube channel Basel Insurance Guide. First of all, I request you to kindly subscribe my YouTube channel and press the bell icon button to get latest new uploaded videos on my channel directed to you. So let's start my today video on my YouTube channel Basel Insurance Guide. My today video is going to about principles of insurance. So let's talk detailed overview on what are the principles of insurance. In insurance, there are seven basic principles that should be upheld, like insurance, insurable interest, utmost good faith, proximate cause, indemnity, subrogation, contribution, and loss of minimization. Number one is principle of utmost good faith. This is the primary principle of insurance. According to this principle, you have to disclose all the information that is related to the risk to the insurance company truthfully. You must not hide any facts that can have an effect on the policy from the insurer. If some fact is disclosed later on, then your policy can be cancelled. On the other hand, the insurer must also disclose all the features of a life insurance policy. Number two is principle of insurable interest. According to this principle, you must have an insurable interest in the life that is insured. That is, you will suffer financially if the insured dies. You cannot buy a life insurance policy for a person on whom you have no insurable interest. Number three is principle of proximate cause. While calculating the claim for a loss, the proximate cause, like the cause which is the closest and the main reason for a loss, should be considered. Thought it is a vital factor in all types of insurance. This principle is not used in life insurance. Number four is principle of subrogation. This principle comes into play when a loss has occurred due to some other person or party and not the insured. In such a case, the insurance company has a legal right to the reach that party for recovery. Number five is principle of indemnity. The principle of indemnity states that the insurance will only cover you for the loss that has happened. The insurer will thoroughly inspect and calculate the losses. The main motive of this principle is to put you in the same position financially as you were before the loss. This principle, however, does not apply to life insurance and critical health policies. Number six is principle of contribution. According to the principle of contribution, if you have taken insurance from more than one insurer, both insurers will share the loss in the proportion of their respective coverage. If one insurance company has paid in full, it has the right to approach other insurance companies to receive a proportionate amount. Number seven is principle of loss minimization. You must take all the necessary steps to limit the loss when it happens. You must take all the necessary precautions to prevent the loss even after purchasing the insurance. This is the principle of loss minimization. So, what is the meaning of policyholder and what does the policyholder means? So, insurance is a legal and financial contract that involves two parties. One party proposes to cover for you or your property, and the other purchases it. The party which gives you insurance is known as the insurer, the other is the policyholder. A policyholder is a person who has purchased the insurance policy. Thus, a policyholder is the owner of the policy and is the name that goes into the records of the company. Most often, the policyholder is one who is insured in the policy as well. In types such as home insurance or vehicle insurance, these are the same, but note that it is not necessary for the policyholder and the person insured to be the same. Both the insured and policyholder are related but can be different as well. For example, if you have purchased a life insurance policy for your wife, then your wife will be the one insured but you will remain the policy holder, or if you have a business and you have taken insurance for your business partner. In both these cases, both the insured and policyholder are related but not the same person. And then the other thing is, what does sum assured mean in a life insurance policy? So, sum insured in a life insurance plan refers to the guaranteed benefit amount under the policy. This is a fixed amount payable against the claim for the covered event. You buy a life insurance to make sure that your family stays financially protected even if you are not present with them. This financial security is provided by the sum assured, which is payable to your family in case you die during the policy term. Naturally, it becomes important to choose a sum assured that will be sufficient for your family, but how much it should be? Three things to consider while choosing a sum assured. So, here are the following things you must consider before deciding on the sum assured. Number one is current income. Your income will decide how much you can pay as premium. The higher sum assured, the higher is the premium. Thus, you need to make sure how much you can spare from your income after handling the expenses. And number two is ongoing financial liabilities. If you have ongoing long-term loans, you should consider to add them to the sum assured of your life insurance plan. And number three is family's needs. Estimate the future expense which will be incurred, such as child's education, child's marriage, and monthly expenses. Choose a sum assured that will be enough to cater all these expenses. So these are the principles and the sum assured meaning and policyholder meaning. And the last one is, who is a beneficiary in a life insurance policy. So, beneficiary in a life insurance policy. Beneficiary means the person whom the policyholder has appointed to receive the guaranteed death benefit of their life insurance policy. It is the person who is entitled to receive the benefits of the policy. A beneficiary can be anyone who has financial interest in your life. Banks or other financial institutions, legal representatives can be the beneficiaries of your policy. If you are buying a life insurance policy for yourself, then you have to appoint a beneficiary before your policy commences. You can choose more than one beneficiary. Following or more information may be required to the beneficiary. Number one, name of the beneficiary. Number two, phone number. Number three, address. And number four, identity proof. So, what is a contingency beneficiary? You have to appoint a contingency beneficiary as well. In case your primary beneficiary dies before you, then your contingent beneficiary will receive the benefits. And why should you have a beneficiary? You are most likely to buy a life insurance so that you can ensure that your family stays financially protected even after you gone off. So, though not mandatory, but it is important to name a beneficiary to ensure that your money and your assets go to the person or persons who you want as the beneficiary is legally entitled to receive the benefit. A beneficiary should be someone whom you can trust, and you can appoint a minor as a beneficiary as well and keep your beneficiaries updated. So friends, this was my today video on my YouTube channel Basel Insurance Guide, which is about two principles of insurance. So I hope all of you now have a well and good idea about what are the principles of insurance and who is the beneficiary and who will get benefits of insurance. So I request you to please like, comment and share this video, and also don't forget to subscribe my YouTube channel Basel Insurance Guide. So friends, we will meet soon in my next video on my channel. So till then, kindly take care and have good day.